Hello and a warm welcome to Econoday Unplugged. It's Tuesday, the 29th of March 2022. Terry Sheehan's on the US East Coast, Max Sato's in British Columbia, Bron Jackson's in Sydney, and I'm Jeremy Hawkins in London. As the war in Ukraine enters its second month, analysts and forecasters continue to reassess how much of an impact there's likely to be on the global economy and prices. As we record, there's been some tentative signs that a ceasefire may be edging closer, but that's far from certain. In any event, US Treasuries are about to complete their worst quarter ever. Commodity markets are all over the place, and talk of a possible recession is becoming increasingly widespread. What is clear, though, is that growth will be hit in some areas hard, and inflation pretty well everywhere is going to be a lot higher than previously anticipated. If you believe the OECD, the crisis and associated sanctions could knock more than a full percentage point off global growth this year and add 2.5 percentage points to inflation. For the time being, there's very little hard data around to give any real idea of what's going on, but we do now have a number of March business and consumer sentiment surveys, and many of these look pretty ominous, with rising inflation increasingly fueled by the situation in Ukraine a major worry. So, in this our monthly global podcast, we'll have a run around our regional experts for an update of what's happening locally. Okay, then. So, Terry, if we kick off stateside, what do we got? Well, to absolutely no one's surprise, the FOMC has started its tightening cycle. But has there been anything of the latest US data to suggest that perhaps developments in Ukraine are having any impact on economic activity?
So far, it seems to be relatively minimal. We've just gotten a bunch of US regional surveys of manufacturing and services over the last week or so, and they're all looking reasonably good. We're seeing modest to moderate growth in many of the Fed districts that report these surveys. But there are signs that things like higher interest rates are beginning to depress the housing market. Consumer sentiment remains very low. We're just getting past the time period where US tax refunds show up. Those will be tapering off in the next few weeks. So I think we're mostly holding our breath to see what happens with the numbers in April right now, although the labor market seems to be holding up pretty well.
Okay, I want to ask you about the labour market in a minute, but we just go back to the consumer side because I'll say we'll get on to Bran and Max in a minute, but certainly one of the trends we appear to be seeing within Europe, which is obviously more exposed to Ukraine, is the consumer side being hit disproportionately. We had the University of Michigan, their March preliminary data out, was it back into last week? And that showed what its lowest reading since 2011, if I remember rightly.
Yes.
So, I mean, do you think that is purely a result of just what rising inflation, say in part due to what's going on in Ukraine anyway, because it's knock-on effects and so on, or is there anything else going on there, do you think?
I think it is largely right now inflation in the parts of the index that look at the current conditions, but it's also a lot of worries about how the geopolitical events are going to play out over the next 5-6 months.
Okay, fair enough. And you mentioned in terms of what we've seen on the business surveys, but by and large, they're holding up okay. And yet, as I think you were talking about on the our last podcast, the outlook for first quarter GDP growth in the States not looking too hot.
No, the early GDP nowcasts are looking for growth somewhere around 1 to 1.5%. We'll probably see the last big revision to those on Friday after the employment numbers are reported. But right now the Fed is putting growth of around 1.8, 1.9% as their longer run. So, growth of around 1% in the first quarter 2022, it might not look all that bad compared to what the Fed's longer run outlook is. It does look worse compared to the 7% we saw last quarter.
Well, that would be pretty good if you could match that one again, I suppose, yes. Let me ask you about the yield curve, because, I mean, for those keen yield curve watchers out there, yesterday we saw the 5 to 30-year part of the curve becoming inverted for the first time since, 2006. Even the 10 to 2-year is sort of barely positive. I mean, does that ring any potential alarm bells for you that there could perhaps be some sort of mini recession around the corner? Or are these curves distorted due to quantitative easing and all the sort of stuff we've seen the central banks doing for such a long time now?
I think there may be some distortion there, but an inverted yield curve is historically a sign of recession and frequently a result of high inflation. So this definitely requires keeping an eye on.
All right. I suppose if we're talking about recession, then you kind of expect it to be a not particularly good employment report on Friday. So let's get on to that then. What's the consensus, and what do you think we're likely to be able to take away from that report?
Well, we've had a couple of really strong months for January and February. So a much slower March probably won't have too big an impact. I mean, we've had added over 1 million jobs just in the 2 months of January and February. So if you look at the quarter as a whole, it probably is going to be okay. But what we're likely to start seeing is further slowing in wage growth, and the rapid gains in the reduction of the unemployment rate are probably mostly done right now. Importantly, I think what we'll be looking for in the report is if we are continuing to see the expansion of the labor force, because one of the big problems facing the labor market right now has been a shortage of qualified workers.
Okay. Let me ask about unemployment. There's some interesting comments from William Dudley, the former New York president, the other day, who was suggesting that if we see the unemployment rate rising by 3 percentage points, then normally that is a harbinger of what he describes as a full-blown recession. Do you think that's right in the current environment, or could we perhaps see unemployment going up perhaps more than 0.3 percentage points as and when it finally does start to turn around without necessarily any implications for growth whatsoever?
Well, I think, if you look at the history, I mean, an unemployment rate of around 4 to 5% is pretty much full employment in
Mhm.
the US economy. So, a slight increase in the unemployment rate probably isn't an immediate sign of recession. But, we have so many unknowns in the US economy right now coming out of the pandemic. We're still not clear where the fundamentals have changed about our labor market. So I think any kind of significant variation in the numbers is going to be something to set off alarm bells for Fed policymakers.
Yeah, I think it's right to put that into context, isn't it? It's so
Yeah.
hard to work out what the new normal is at the moment. All right, my last question for you then would be that markets everywhere seem to be becoming much more agitated now about what's happening to inflation. It seems that almost everyone's talking about a 50 basis point hike from the Fed in February, in May, perhaps another 50 basis points at the meeting after that. Do you think they'll start increasing rates more aggressively, or are they going to stick with the kind of 25 basis points every meeting?
There's certainly been a lot of chatter out there about that possible 50 basis point increase, and some of it is coming from Fed policymakers. I certainly think they are prepared to do 50 basis points at the next meeting, especially if inflation does not show any sign of easing up, or heavens forfend, it continues to rise. A lot of the individual states here in the U.S. have started to do things like stopping collecting state gasoline tax and such to try and reduce the price of gasoline and ease inflation for consumers. So it's going to be a little hard to tell what the underlying data looks like with these sort of artificial impacts on fuel prices.
Who'd be an economist, eh? All right, Terry, thanks for that. Anything else you want to put in from your side before we move on to Max?
Not for me.
Okay, great. Thanks, Terry. Right, if we go across the border then, Mr. Sato, Canada. Looking at your numbers, it seems that by and large the Canadian economy is doing pretty well, certainly the labour market anyway. But I did notice that consumer confidence has come off quite sharply over the course of the last few months. So again, a bit akin to the States. Do you think it's the case that the Bank of Canada is going to concentrate on inflation being well above target and still rising, or are there any kind of concerns there that perhaps growth is starting to slow?
Judging from public remarks by officials and media reports on what's happening here, looks like Bank of Canada, like the Fed, will have to be aggressive, forceful, and raising the key rate by 50 basis points for the next upcoming meetings in April, June. And
so you're going for
maybe,
50. Sorry to interrupt. You're going for 50 basis points at the next meeting now.
Yes, I think that's almost a done deal.
Okay. So
then they'll probably have to keep raising rates to at least to the lower band of the current estimate of the neutral rate, which is between 1.75 and 2.75. Maybe followed by 25 basis point rises.
Okay, so is there any concern coming out of sort of BOC or indeed the government about what may be happening to the global economy in the wake of the fallout from the Ukraine crisis and rapidly rising prices and everything else? Or do they still come across as being perfectly comfortable with the way GDP growth is likely to come in, consumption holding up and so on?
I think they, like any other countries, they're also saying there is uncertainty, and policy decisions will have to be data and event dependent. But looks like pretty much both the economists and policymakers are pretty bullish about it.
Okay, fair enough. Any else from the Canadian side?
And one crisis we have here is maybe in the States too, the housing market. A lot of people cannot afford to rent or renew the rental place because prices are going up high, including the rents, and there's not much protection for renters and first-time home buyers. So you cannot just raise interest rates and try to cool off the super hot real estate market. The government regulations, provincial and federal, will have to come in.
Okay, fair enough. Thanks for that. Before I let you go, let's move to Asia while we go, in particular Japan. Not so much perhaps in terms of the real economy, but I want to ask you if you've got any thoughts about the exchange rate, because we've seen the Japanese yen slide, well, not just against the dollar. By all means, we fell through dollar yen moved above 120 for the first time earlier on this month since February 2016, if I remember rightly. Yesterday, it saw its lowest, the yen saw its lowest level since 2015. Now, typically speaking, when we go through periods of geopolitical problems and albeit global financial worries, the yen is the traditional safe haven currency as far as Asia is concerned. But we've seen the currency losing ground both against the dollar, which perhaps is fair enough because this is very much a dollar bullish environment at the moment. But it's also lost ground against the likes of the Swiss franc, which by all means is the European safe haven currency, but also against the pound, British pound, and also against the likes of the euro, which is one of those currencies which really has been ultimately perhaps the most negatively affected by what's going on in Ukraine. So I wonder if you've got any thoughts as to what's kind of happened. Has there been some kind of regime shift in terms of the way investors are looking at the yen? Is it simply the case that the BOJ is so determined to keep policy dovish while other central banks are tightening that it's just undermining the currency, or do you think there's more going on?
I think it's both, Jeremy. The investors, forex market participants, they can choose whatever the theme of the month. One month they might say, okay, we should buy yen because safe haven currency still. The next month they could say, wait a minute, Bank of Japan's resuming unlimited fixed rate operations to defend the 0.25 line in the long-term bond yield. And that's one thing. So you don't know which way the wind's blowing until you get there. But at the same time, as you can see, the BOJ's 2% inflation target, they didn't choose it. Kuroda's predecessor, Shirakawa, he had to defend the BOJ's independence of political influences. So he was forced to agree to 2%, while previously they said 1% would be good enough. So then this politically motivated 2% inflation targeting was basically originated by then Prime Minister Shinzo Abe. He actually used that framework to win the election, to come back to power. But then, after a few years of a trial of massive cash injections, but that was followed by a plunge in crude oil prices from 2014 to 16. Then politicians sort of gave up on the idea of pushing zero inflation to 2% and say, maybe we don't have to do this anymore. But unfortunately, there's an agreement between the government and BOJ, and they cannot just drop the 2% target, primarily because right now we have about 120 dollar yen rate, but who knows when the positions built up and there's a fall back in the dollar towards 100 yen, and they can't just say, okay, we're going to drop the 2% target, maybe we'll target 1 or 1.5. That could cause a huge dollar buying, yen buying. So it's a very delicate situation. That's why all they can say from the Ministry of Finance is that we are keeping close contact with the Treasury Department, other G7 members, watching the movements in the forex market. But as you can see, if it's yen selling intervention, Japan can just print money to intervene. But dollar selling, they have to use the foreign reserve. So there's obviously a limitation to how much they can go. And unless they have a really forceful interventions, rounds of intervention at great timings, they just give investors a good opportunity to buy back dollars when it comes down a bit.
Yeah, intervention is always a difficult thing for central bank, but it is interesting how we seem to be getting back to the old days of the yen becoming one of the investors' main borrowing trade currencies. So you can borrow cheap in yen and invest in dollars or whatever currency you want. Let me ask you quick in terms of the numbers. This week we'll get the BOJ's Tankan survey. What's expected from that? Is that expected to reflect the kind of increased global environment in terms of worries about what's going on?
Typically, the theme is Ukraine, and not just the geopolitical risks, but they're already paying much higher prices for imported energy, raw materials, food, everything, at least at producers' levels. So that obviously dented the sentiment in March. This survey was conducted from late February to late March, but basically cutoff of responses is around mid-March. So at the height of the Ukraine crisis. So almost everywhere across the board, we're going to see the sentiment falling from the previous survey.
Yeah. Okay, great. Thanks for that, Max. Anything else from your bit on Japan?
I just spoke to my former colleague, and he said the commuter trains are back to full capacity, not capacity, but crowded, like usual, crowded in Tokyo. So unlike in some of the economies, Japan's still like analog and face-to-face. So what does it mean? Does it mean they're sort of going back to full reopening and retails and spending on hotels and traveling will come back? That's not. That's still uncertain. So we'll see how things go in retail sales and household spending data coming up.
Okay, lovely. Thanks for that, Max. Right, across to Bron, Mr. Jackson, for your input. Let's kick off with China, if we can. Obviously, if you've got anything you can say about whether, well, say China in terms of economics and perhaps even politics with regards to what's happening in Ukraine at the moment. But also just quickly to start off with, there's, again, big worries about supply chain disruptions due to the zero COVID policy out there. And Chinese COVID cases of late, at least, have been through the roof. So can you perhaps give us an update what's happening on that side first?
Yeah, I think that's definitely the number one story to be aware of and to track going forward. We know I think we've been talking about China's zero COVID policy for 6 months or so on this podcast and our notes, and it's just they're showing no signs of moving away from that policy at the moment. If anything, they're just doubling down on it. Particularly Hong Kong over the last 6 weeks or so we've just seen some extraordinary scenes from the efforts that public authorities there are making to try and get on top of the pandemic, and it's just having a devastating impact on the economy and on people's lives as well, to try and get over the pandemic there. But it's not just Hong Kong. It's that's probably one of the more visible places that we do have sort of access to when we're looking at China, but it's right across the board. And now we're seeing a very tight lockdown happening in Shanghai, starting over last weekend. That's a huge city, huge part of China's economy, and we're right in the middle of a very severe lockdown now. So I'm seeing all the press reports about how businesses in Shanghai are coping with it, but it's bound to have a pretty major impact on the data going forward. And that sort of that follows some reasonable official data that we did have a couple of weeks ago for the first 2 months of the year, showing a bit of a pickup in industrial production and retail sales. But if you look at the PMI numbers, pretty weak, and it's hard to see how we don't see some further weakness in the official numbers as well going forward.
Okay, does this mean then that it's still the case we're looking for some kind of additional loosening of policy in some shape or form coming out of the People's Bank of China?
Yeah, they haven't made any further moves in the last sort of maybe 4 to 6 weeks. They were sort of tweaking things around the end of last year and maybe a couple of times really early on in this year. But we're talking about little changes to the loan prime rate or changes to the reserve requirements for banks. Just things I think on the margin to try and ease liquidity conditions and help get bank lending out to companies that need it. So I think that's their preferred way of dealing with it at the moment, and we might see further moves in that direction if we do see some more weakness in the activity numbers. And they are also making efforts on the fiscal side as well. But it's still quite striking just how committed they are to this policy of suppression and elimination of the virus to try and deal with it. Whether that might change after some key meetings later in the year. We thought after the after the Winter Olympics that might have been the trigger to try and relax some of those things, but that hasn't happened yet. So it's going to be just an interesting watch to see. I think economic policy is interesting, but COVID policy is the main thing to be watching out of Beijing at the moment. Because you're absolutely right. This is having this is going to continue to cause all these supply chain problems in particular. I mean, if you take out very important industrial cities in China and sort of take them out of operation for a while, then it's just going to have a flow-on effect right across the global supply chain.
There's so much impact in these chains at the moment, isn't there? Let's quickly ask before we leave China. Let's assume that we do see some form of Chinese easing, in terms of interest rates or reserve requirements, whatever it may be. And at the same time, we've also got, from what Terry's talking about, with effectively US interest rates rising increasingly rapidly. Presumably, there's going to be some implications for the the Chinese renminbi exchange rate. Do you think the authorities out there are not concerned about the potential implications of these widening differentials and pushing the currency down? Or do you think even they might actually quite like that, given the fact that they're having to ease policy to get the economy going in the first place?
Yeah, I mean, that could be something on the margin that does help their easing policy, but in general, I don't think that's their number one strategy or a major concern at the moment. They're like the rest of us. They're trying to deal with the impact of higher commodity prices right across the board, and so that's probably again the main focus of their attention at the moment. And energy prices obviously like a tax at the moment, and that's going to offset a lot of the other factors that are happening.
Okay, and just I suppose I already said before we leave China, we've got a high-level summit between the EU and China coming up at the back end of this week, and obviously one of the other main focal points for investors currently is which way China is going to swing in terms of do they support the Russian side of what's going on in Ukraine, or do they support the the Western side? Do you have any feeling as to what they're trying to achieve at the moment? Is it a balancing act, trying to keep in sort of both the court, keep the ball in both sides of the court, or do you think at the end of the day they're going to come down on one side more than the other?
Yeah, I mean,
that's
I
probably
don't
an unfair question, but I'll ask it anyway.
No, I agree. I mean, it's interesting, definitely, and I'm following like everyone else, but I don't pretend to have the right level of expertise to call what Beijing's going to do on something like Ukraine. I mean, that's above my pay grade. That one, it's it's obviously a key factor in the conflict. What China does to either put pressure on Russia or to go easy on Russia. So, but sitting here in Sydney, I'm afraid I don't really have any particular insight into that. But it's obviously something that the whole region is watching to see what path China takes. As soon as Russian tanks rolled into Ukraine, a lot of people were thinking, okay, so what does this mean for sort of China's outlook towards the rest of the region and the rest of the world? And again, that's something that we can't really just answer in a 2-minute sort of soundbite. Yeah. It's a really, really important issue, obviously.
Yeah. Okay, fair enough. Right, and let's move on to something which you do know an awful lot about. That's country, home country, Australia. When we last spoke, you were saying then just how dovish the Reserve Bank of Australia was, particularly by international standards anyway. And since then, we've had tightenings from other central banks, Fed, Bank of England, Bank of Canada, Bank of Canada, and others as well. So we just also had a new federal budget. So, I mean, does any of this have any implications for the RBA? Are they going to become less dovish, more hawkish, or are they going to stand pat?
Well, they're holding the line in terms of their rhetoric. They're saying, okay, inflation's gone up, but it's still pretty low compared with most other countries. What are they saying? Wage growth is still sort of not where they think it needs to be to have inflation sustainably within its target level. So, we're getting sort of regular commentary out of senior RBA officials saying that they're not thinking about moving, in the next month or so, but they are gradually sort of, I think, getting people prepared, ready for a move perhaps later in the year, which is definitely an advance on where they had previously said. So, I think the main phrase that they're using is that a move later this year is plausible. That's the language that they've been using, and of course you can see why they have had to at least make that concession to the markets, because inflation has picked up and is probably going to pick up further in the near term. We're seeing rate hikes by the Reserve Bank of New Zealand, the Bank of Korea. So around the region, we're starting to see moves in that direction, and I think it's just a matter of time before the RBA does make a move, whether it's in 6 months' time or in 12 months' time. I mean, that's the That's the question at the moment, but that's clearly the direction we're heading to. And you mentioned the budget that came out about 12 hours ago here in Sydney, and I think if anything, that does probably add to the likelihood that we will see a move in policy rates later this year. We have a national election coming up in the next couple of months, and so the government has been pretty aggressive on the fiscal side, shall we say, with the budget. Some tax cuts, some extra spending to try and offset the impact that cost of living increases has had on many households here in Australia. And so, all things being equal, if you sort of give a bit more juice to fiscal policy, then that strengthens the case to try and move the other way on monetary policy.
Yeah, right. Okay, and let's it's a round off in terms of what I was going to ask you anyway. In terms of New Zealand, the RBNZ, and we talked for a while now about just how hawkish the RBNZ have been amongst the major central banks. I guess that's still the case. But I was going to ask you, because we've had such a sharp increase in COVID cases in New Zealand, whether you think that might have implications for perhaps slowing down the rate of increase of RBNZ tightening, or is it still too small to have any significant impact on the economy?
I think it'll be a factor that they'll keep in mind. Definitely, they're not going to just blindly, hike every time they get together and have a meeting. They'll weigh up what those public health numbers are indicating for the economic numbers, and so I think we can have confidence that they'll judiciously assess all the relevant information. But I think they've made clear their preference is to as they would put it, normalize monetary policy, and so that's sort of what I think will happen over time. But it will definitely be impacted by what the public health data is showing. Okay,
excellent. Anything else from your side, Brian?
No, I mean, there's just a lot of common themes. I think obviously right across my region that Terry and Max have also discussed it in their parts of the conversation. The housing market in particular, that's definitely an issue here in Australia. We are though seeing some signs of it cooling off, and then obviously if we do see the RBA start to hike rates at some stage, then that could also start to be a real factor for a lot of people here in Australia.
Okay, lovely. Thanks for that, Brian. Right, let's round this off with my bit of the world then in terms of Europe. Well, I guess for some countries like US, Canada and Australia for that matter, rising energy and other commodity prices help at least part of the economy because they are producers as well as consumers. But of course for Europe, where we've got more than 90% of energy being imported, any kind of increase in energy costs is essentially bad news for the continent. So what have we got over this side? Well, what we can say is that certainly some of the survey data have been pretty poor. By and large, though, it's been more to do with the consumer sector than the business sector. So the March PMI actually held up quite well. It was 54.5, which by European Union standards, or I should say Eurozone standards, is a pretty decent number. But even so, within that, the output index hit a 5-month low. Indeed, that was one of its worst readings seen for quite a while. And in fact, looking at some of the other surveys amongst the individual countries, some of those readings have really been distinctly poor and distinctly ominous in many ways. So the EFO survey out of Germany, which is often seen as a better leading indicator of what's happening to overall European growth and the likes of the PMI itself, the expectations component of that saw its steepest fall in March on record. So it fell even more than we saw when it slumped immediately after the arrival of COVID. And that was a broad-based decline at all levels, all sectors across industry, with the manufacturing sector particularly badly hit. So there's certainly indications from that the German economy is going to suffer quite badly. Out of France, again, consumer confidence there much more than the business side. That saw its second steepest fall in March. only second to the initial response to when COVID arrived back in April 2020. A similar sort of picture coming through in Italy. Again, the overall industrial side holding up rather better, but in terms of consumer confidence, that simply plummeted. And again, that saw one of its steepest falls on record. We'll get the full economic sentiment index for the Eurozone on Wednesday. That's quite a closely watched gauge of what's happening to general confidence levels in the Eurozone tomorrow. Given what the market's currently expecting, I suspect there's going to be some downside risk to that as well. But in a nutshell, the early indications are now that the consumer sector, or these households in general, would appear to be getting into the kind of state whereby they could retrench quite significantly. They've been hit extremely badly by rising fuel costs. There have been some packages put forward by various governments to try and limit the impact on household budgets, but nonetheless, if things continue to go on as they are at the moment, then the chances are we could see a significant slowdown in what was already really a less than impressive growth rate coming out of the Eurozone. For the UK, well, I guess not so long ago, interest rate expectations were extremely strong for the UK, for the Bank of England anyway. Some of that has been tempered after the bank's meeting earlier on this month, where they kind of backpedaled a little bit and suggested look, perhaps these markets were getting a little bit too carried away. And are now suggesting there's only going to be a further modest tightening as possible over coming months, and rather than suggesting it was pretty well a done deal. Nonetheless, the overall background still looks to be that interest rates in the UK, like most of the world, will be heading higher over coming months. Now, in terms of the impact of Ukraine, well, again, in terms of consumer confidence, there was a very steep fall coming through in the March data. We're back there to November 2020 levels, which is when the last big wave of COVID really started taking off. We also see now at the same time, as all the other guys have been talking about, big increases in inflation coming through in most of the PPI and the CPI data, and also crucially in terms of the expectation numbers as well. One of the monthly surveys there is suggesting that the 12-month household inflation expectations are up now at an all-time record high, and the longer-term rates also moving towards that direction as well. So when you start pulling it all together, I guess, particularly for Europe, it is a particularly difficult time for central banks, in the sense that more and more as we start to get this data coming through, it's suggesting that there will be a significant slowdown in economic activity. But as everybody else has been talking about, inflation is going to rise for some time yet. Now, a lot of it's clearly is going to have to do with how long this war in Ukraine continues. But even if the latest round of talks, which, as I mentioned in the intro, to actually achieve something in terms of getting some form of ceasefire coming through, what's already in the pipeline means that inflation rates are going to move probably significantly higher for a little while yet. And central banks, which for quite a lot of central banks have been seen to be behind the curve for quite a long time, really does suggest that interest rates may have to move up a good deal further yet. The roundup from my side from the Swiss National Bank, she mentioned that they had their quarterly monetary policy meeting last week. And again, I guess as we talked about, a quarter ago when they had their last meeting, the interesting thing coming out of that was that given how much the Swiss franc has appreciated, as we've talked about previously, it is the key safe haven vehicle in the currency market as far as Europe's concerned. It seemed quite likely at the time that the SNB, the Swiss National Bank, might come out and make some noises to the effect that, look, this currency is getting seriously overvalued now. But in actual fact, they just stuck with their previous description, which is just highly valued. So I guess you put it all together, it sort of suggests that they finally decided now, well, look, this Swiss franc, clearly the equilibrium value is a good deal higher, good deal stronger than we previously thought, and they're just going to have to ride with it. Now, whether or not they'd actually be prepared to allow the euro-Swiss franc cross rate, which as we speak is trading, about just over 102, to fall below parity is another issue. I think they'd be loath to do that because just for technical reasons, apart from anything else, we could see a significant amount then of additional Swiss franc buying and euro selling, which could take it well below parity. I don't think they really want to see that, but it really does seem now that we're in some kind of new regime as far as the Swiss franc currency is concerned, in which it's going to remain that much stronger for longer than previously anticipated. So it's going to be an interesting currency pair, I think, to watch as we go forward. Before we end, then what else should we mention? There will be an OPEC plus meeting, so that's the OPEC guys plus Russia. They'll be meeting on Thursday That could potentially be one of the most interesting gatherings this year, since, and it will certainly have implications for all prices anyway. The group will again be deciding whether they want to stick to the current plans of increasing output by 400 million barrels a day, or perhaps they're going to increase a bit more to try and pull down these energy prices. Everything coming out of it so far suggests that they're going to stick with the current plans, in which case all prices are going to remain under pressure. And also to mention, my chat to Brian, there will be this EU-China summit on Friday, and that's going to be important potentially anyway for deciding or getting some clues about which way China is going to go, which could also ultimately have huge implications in terms of how long this war in Ukraine is going to continue for. Okay, then, well, let's conclude this thing. I guess one of the main takeaways from this is there's so much uncertainty around in the world at the moment that it's almost impossible to say what the heck is going to happen. Indeed, listening to the Bank of England Governor Andrew Bailey yesterday, he said that the Russia-Ukraine war has made it, quote, nearly impossible for the Bank of England to forecast the UK economy. Good for him, because at least he's being honest. I mean, it's both honest and pretty well a situation which all the central banks find themselves currently as well. COVID, which of course hasn't gone away, is back in Asia. It's certainly back in Europe again. It also appears to be perhaps drifting up in America as well. It's almost kind of been put on the back burner now, but bear in mind that is yet another issue which is going to hit all these supply chains and help to keep prices high. But COVID plus Ukraine make for a highly combustible mix as far as financial markets are concerned, and clearly it means for divergent trends in economic activity and inflation. For now, looks as if the central banks are more worried about getting inflation under control and supporting economic growth. Certainly that's how financial markets see it anyway. But that could yet change should unemployment start to rise again. In any event, in the end, it'll all come down to the data. So best keep up to date with all the key policy moves and economic statistics in Econoday's global economic calendar. On behalf of Terry, Max, Brian and myself, thanks for listening. Hope to see you again next time. Bye for now.